Hey guys, Roland Hermio again with Say Financial. So this topic I've actually been dying to do for a while. If you guys are out there, are Dave Ramsey fans, or if you are a Primerica agent, this video is for you. So one common refrain from those two groups of people is been repeated numerous times online. So just wanted to cover and clarify a couple of things. So the statement typically is cash value life insurance is a ripoff because when you die, the insurance company keeps your cash value. So just wanted to make a clarification of how the cash value life insurance actually works, so you guys judge whether or not that statement is true. Okay, first of all, when you are, and this is an example on an IUL. Okay, when you're designing an IUL, typically you're leaning one or the other. On the one side, you need IUL. If you needed death benefit, you would lean more towards that side of things as far as funding it. The other side of it is building cash. And you can move the scale depending on what your intentions are. Meaning that, let's just take a premium of $100. If you want more death benefit, you're going to want to use $90 of that 100, $80 of that 100, $70 of that 100 towards the death benefit payment. So you would buy more death benefit. Now, if you want to put more cash, more of the money towards the cash, you buy less death benefit and say put 90 of that 100 towards the cash accumulation. And again, you can move that scale along the way. So you have two options when you're designing it. Option A, or a level, works this way. And let's fast forward. Let's look at $100,000 death benefit, and let's fast forward 8 years down the road, right? Because they're saying the insurance company is going to keep your cash. On an option A level death benefit design, let's say 8 years down the road, you've got $78,000 sitting in the account on a $100,000 death benefit design level. If you take that $78,000 and subtract it from that $100,000, that's a $22,000 NAR. That's net at risk to the insurance company, meaning that you're only paying insurance death benefit on 22 grand instead of 100,000, because 78 is already your money. So you're self-insured because you built up enough cash in this policy because you went heavy. Let's say you put $90 of that 100 towards the cash, and 8 years down the road, again, this is not to scale, but this is just for illustration. You've got 78,000 in cash value of that 100, so 22,000 of that is still at risk. So you're paying insurance, death benefit, only on the 22,000, not that full 100, because 78 is your money. That's the level death benefit. So I hope you guys catch that. On an increasing death benefit, same 8 years down the road, same 100,000, but an increased design, meaning that if you've got 78,000 of cash built up, your death benefit is now 178,000, because your intention on the increasing side is to keep $100,000 of death benefit that you're paying for, right? So as you build this up, it's always going to be $100,000 on top, increasing, net at risk to the company. So you're always wanting to pay $100,000 worth of death benefit over and above your 78,000. That's how increasing works. So in this design, you would get your 78,000 cash and your 100,000 on top, leaving you 178,000. That's the increasing. Again, the insurance company is not keeping your money because they're giving it to you here, and they're also giving it to you here. The only difference is the net at risk. Here, you're always paying 100 grand over and above your cash value. Here, you're paying the difference between the two. So when you get to this point, and whether it's 8 years down the road or 20 years down the road, whatever the net difference is the only part you're paying insurance on, which is really works out great if you design it properly. And let's say you're age 70 and you've reduced the net at risk to, let's say, 10, 15 grand. You're only paying 10, 15 grand worth of death benefit at age 78. That's how you keep your policy costs down. So that's how that works. The insurance company doesn't keep your money that you didn't pay for. It's just in this design, you're paying a reduced net at risk. This design, you're keeping it at 100,000. And then we'll go further than that on the example. If we go down the line a little bit further, let me show you what happens beyond the 8 years, even on a level design. Okay, again, let's take that same 100,000 original design, option A, option B. Okay, and let's fast forward to, let's say, 30 years later. Let's write it here. Okay, 30 years later. Well, actually, let's go to 15 years later. That same 100,000, let's say the cash value, and this is the death benefit. Same 100,000 starting design, but 15 years later, let's just say you got $143,000 in cash. By rules, by law, by IRS rules, to keep the definition of life insurance, the cash value can never be greater than the death benefit. So once this got past 90,000 and it starts to surpass the 100,000 original plan, this also has to increase. So here, and let's say the corridor that they're keeping is $10,000. This now becomes 153 grand death benefit because that corridor has to be kept. And it doesn't have to be that, but by rules, by law, to keep it from becoming an investment, that cash value can never be greater than a death benefit. So even on a level death benefit, this can go beyond that 100,000 original plan, and now you've got 15 years later, you've got $153,000 death benefit, but 143 is really yours. So you're paying insurance cost on the 10 grand. That's how that works. Insurance company ain't keeping your money, okay? They are doing it contractually as it's designed. So hopefully that helps. Net at risk is what you're paying insurance on based on your age at the time. Insurance company's not keeping your cash. You just never paid the full amount unless you're doing the increasing design, and in which case the cash value is always going to be higher than if you kept it on level. Now, I don't want to get too much in the weeds because I want to keep this video short, but the reason somebody might go in an optional design here is if you're trying to shove more money in there and you don't want to increase, you don't want to start off with too big of a death benefit because down the road it could cost money, higher mortality cost. Another video altogether, but I hope you guys out there, especially the Dave Ramsey fans and your term and investor difference Primerica people, I hope that's clear. Not here to fight. Actually own a lot of term myself, and I do invest. So do I believe in buy term and invest? Yes, but not the way you guys are speaking. Roland Harmio, Safe Financial. 985-464-9595. See you next time.